Can you explain how FGEN defines environmental infrastructure and why this is a compelling investment theme today?
Yeah, absolutely. So we really see environmental infrastructure as being the systems that enable decarbonisation and sustainable resource management. So that might be projects or asset-backed businesses that support more environmentally friendly approaches to economic activity, that support the transition to a low carbon economy, or that mitigate the effects of climate change. And being infrastructure assets, these typically come with certain characteristics that might be long-term predictable cash flows with inflation linkage, or stable economic and regulatory frameworks, or that come with proven operational track record, demonstrable track record. And really we see this subset of infrastructure as being one of the most exciting and largest, most significant investment opportunities of our generation.
How do you balance risk and return across your three pillars: renewable generation, other energy infrastructure, and sustainable resource management?
So as you say, we've got these three pillars, and really what we see ourselves as being a diversified portfolio across them. So what we have tried to do is layer up combinations of assets that are complementary to one another. So in its most basic form, that might be putting wind and solar assets together. I think we can all guess that when the wind's blowing, it might be more likely that the sun's not shining, and vice versa. So we have a natural hedge across our assets. That means we're much less exposed to, in that example, individual risk factors like weather patterns. And by putting more and more of these assets together, what we can do is introduce more resilient asset characteristics and better risk-adjusted returns overall for the portfolio.
What's the geographic split of assets in the portfolio, and how does location affect performance and risk?
So at the moment, about 90% of the portfolio is in the UK. And I think it's fair to say that the majority of the portfolio will always be in the UK. That's where we understand our assets, and more importantly, our investors understand those assets. And it's easy for us to communicate to new investors and for them to get their heads around it. And that's a really important factor for bringing on new investment. We do, however, have vast experience outside of the UK. So FGEN's investment manager, Foresight Group, has got 14 billion of assets under management, of which a large proportion of that is outside the UK. So we can lean on the experiences learned elsewhere within the manager. So we do have assets at the moment in Europe, and we'll continue to evaluate on a case-by-case basis where to deploy capital. But we certainly don't see any shortage of pipeline in the UK. So I think that's probably where we'll stay with the focus for FGEN.
Renewable generation makes up 73% of the portfolio. Do you expect this weighting to change over time?
Yeah, so I think the 73% will change over time. I think it's natural that as more opportunities emerge, not just within renewable energy generation, which will no doubt continue to need significant investment to deliver on the net zero targets that we have within this country. But we'll see other opportunities emerging within grid infrastructure or within sustainable resource management. So we have a portfolio that has allocations to each of those. And I think as we seek to recycle capital away from some of the lower returning sectors and in towards other sectors as they mature and become attractive, the percentages will naturally fluctuate. Although I think it's fair to say that renewable energy generation will always have a significant role to play because it is such a strong income provider for our portfolio.
How predictable are the cash flows from your assets, and what degree of inflation protection do they provide?
So one of the primary objectives of FGEN is to deliver a stable income for our investors. And therefore we have a carefully constructed portfolio that derives a lot of its revenues from secured sources, for example, government subsidies or long-term offtake agreements. And typically these will be long-term agreements that can stretch out to 10 to 15 to 20 years, and that provides us with a very secure revenue profile. To support that as well, we don't just have reliance on government subsidies. FGEN has a very flexible mandate that generates revenues across different frameworks and different commodities. So, for example, we generate revenues not just from power, but also from heat. We generate revenues from our clean transport platform, from controlled environment, and from waste and water management as well. But at all times, there is a strong focus on achieving a high level of secured revenues. At the same time, we do that without compromising on a core infrastructure characteristic that is inflation linkage. And many of our revenue contracts do have explicit inflation linkage.
Can you discuss dividend policy? What yields can shareholders expect and how sustainable are they?
Indeed. So as I say, FGEN, its core priority is delivering a stable dividend to our investors. We have progressively grown our dividend for 11 years in a row now, and our dividend target for this year is now 7.96 pence, which we are well on track to deliver with a comfortable level of dividend cover. And at the moment, given our share price, that equates to a yield of around 12%. Which we think is a very attractive yield, particularly looking at the underlying characteristics of the company. We have very predictable cash flows, we have very low gearing, and we also offer the potential for capital growth alongside that progressive dividend.
How do you see the fund's growth trajectory over the next 3 to 5 years?
So the fund's growth trajectory over the next 3 to 5 years is very positive, and that comes down to the nature of our portfolio and the mandate that FGEN has. So first of all, FGEN invests across a very wide range of environmental infrastructure, across renewable energy generation. And when we talk about renewable energy, we don't just mean wind and solar, we mean biomass and AD and hydro. Other energy infrastructure such as clean transport and energy storage, and also sustainable resource management such as waste and water management and our investments into controlled environment. And so these are all sectors that have a very positive growth trajectory, but also it means that FGEN is not solely reliant on just wind or just solar to achieve that growth. And within the current portfolio, we have some exciting assets that we call our growth assets, and which are in which are all in an earlier stage of their life cycle. These are investments into clean transport, into our land-based aquaculture facility in Norway, and our glasshouse, our co-located glasshouse facility. Now these are all investments that are at a slightly earlier stage in their life cycle, and which are all in varying stages of operational ramp up. And these growth assets all offer the potential for meaningful capital appreciation. And our strategy for these assets is to continue to grow them, to work through their operational ramp up to a point of maturity, which we think will be within the next couple of years. And at that point, we will look to realise the value that we've created. And as I say, that does offer the potential for meaningful capital appreciation there. And so therefore, we think that within the portfolio itself, there is a very good opportunity for growth.
What is the current leverage level across the portfolio, and how does that affect returns?
So we have a relatively low level of leverage, particularly compared to the rest of the infrastructure renewables peer group. Our gearing is currently at around 30%, and that consists of both project level debt within project companies themselves, and also the fund level gearing. All of their debt that sits within our project companies is fully amortizing and with fixed interest rates, so we don't carry any risk there with respect to interest rate volatility. And our valuation assumes that all of that debt amortizes as well. So we take a very conservative view on gearing, and combined with one of the highest weighted average discount rates across the portfolio, we think that puts us in a very strong position, particularly compared to the rest of the peer group.
Have you had any exits from the portfolio yet, and what have they taught you about valuation and market appetite?
Yes, so last year we sold about 10% of our portfolio via 2 transactions. That was a sale in part of our AD portfolio to a company called Future Biogas, which is also the operator of those AD facilities. Now that was a very good sale for us that recognised a premium to our holding value. And also it meant that the alignment between FGEN and Future Biogas as the operator is now stronger than it has ever been, given that we are now co-shareholders together. And we are working with Future Biogas on a series of value enhancements across that portfolio, which is very exciting for us. The other transaction was the sale of our solar rooftop portfolio, also at a premium to the holding valuation. And that transaction, the objective there was to recycle capital from a non-core, lower returning part of our portfolio to put that capital to better use elsewhere. What we learned from those transactions is that, firstly, because we're able to recognise premiums to holding value, it gave us a lot of confidence in our valuations. It also taught us, I think, that it is probably a more challenging market to sell into compared to previous years. The other thing we learned from those exit processes was that compared to previous years, it is arguably a more challenging market to sell into. And that really derives from the interest rate volatility we have seen over the last few years. And so what that means is that any sales process has to be very well planned, it has to be well managed, and you really have to think about the buyers that you are targeting. But fortunately, we were able to do that, and as I say, both of our transactions realised premiums to holding value, so it was a very good outcome for us.
Battery storage and low carbon transport are only 10% of the portfolio. How big an opportunity do you see in this space?
Yeah, so they sit within our other energy infrastructure pillar within the portfolio. And we do see a lot of opportunities within those sectors. I mean, if we take batteries as an example, as a manager, we're definitely convinced that batteries will play a vital role in the transition towards net zero, towards electrification, particularly as we take on more renewable energy, more intermittent energy onto the grid. But for us at FGEN, we have an allocation, but it's a fairly small allocation to batteries. Whilst the returns themselves might be attractive, there are certain characteristics like trading of revenues that we're not so fond of. So they definitely have a role to play, but for us there are loads of opportunities within that sector, within that pillar that we prefer. So Foresight as a manager has experience in things like interconnectors, pumped hydro, in grid infrastructure, which really would play a complementary role to our portfolio rather than just introducing additional risk factors. So very important sector, very important pillar for us. And definitely an area that we can see some really exciting growth opportunities.
Controlled environment agriculture and aquaculture are relatively new asset classes. What excites you most about those investments?
Yeah, so we like those assets, and they're two of the more recent investments that we've made at FGEN. And I think what we really like about them is the characteristics and the diversification that they provide. So if we take something like our glasshouse investment, that was originally seen as a value enhancement opportunity for one of our existing anaerobic digestion facilities. So we were looking at what we could do with the land adjacent to that facility to try and capture some of the surplus heat and power that was being generated but was just wasted. So the idea was that we would build a glasshouse next to it and then a big private wire between the two facilities so we could capture that surplus heat and power. We could then monetize that by selling it to the glasshouse, so creating an additional revenue stream for our anaerobic digestion, our AD facility, as well as at the same time providing low-cost green energy to the glasshouse. So that was a win-win for both of those opportunities. And that is often referred to as the circular economy, the relationship there between those two investments. And that's something that we really like, and we're looking for more and more opportunities where we can implement those sorts of characteristics, those sorts of relationships.
With rising demand for electrification, where do you see the most promising opportunities for new deployments of capital?
Yeah, so there is absolutely increasing demand for power in the UK, and that is resulting in opportunities not just in power generation, but also in downstream contributors to decarbonisation. An example of that would be heat. So heat is a sector that, unlike power, has perhaps not been at the centre of government decarbonisation plans, but it is increasingly becoming clear that that is a sector that is still very reliant on gas and fossil fuels ultimately, and so the electrification of heat is very important going forward. So we see plenty of opportunity there. Outside of electrification, we see a range of opportunities that contribute to decarbonisation. Transport is a very important one, and our investment into our CNG platform in the UK is really exciting. That is providing biomethane gas to heavy goods vehicles to move them off of diesel, and that is a platform that is growing and progressing very well. And finally, an opportunity that is of real interest, and a sector that is of real interest to FGEN is biomethane. We have a good portfolio of anaerobic digestion facilities within FGEN that produce biomethane, and it's increasingly clear that biomethane can play a really important role in decarbonisation and achieving net zero. In that, first of all, it is a far cleaner alternative to natural gas, and it can also utilise existing gas infrastructure. And the UK government is planning on releasing a biomethane framework plan at some point next year, which we hope will really consolidate biomethane's position as central to net zero targets as we go forward.
How does FGEN differentiate itself from other listed renewable infrastructure funds in the FTSE 250?
So FGEN's broad investment mandate certainly sets us apart from many in the peer group. We invest across a very wide range of environmental infrastructure sectors, across renewable energy generation, other energy infrastructure and sustainable resource management, whereas many in the peer group have a much narrower focus on, for example, just wind and or solar and storage. And so that means that we are not reliant on the wind blowing or the sun shining to generate revenues. We do effectively generate revenue whatever the weather. And that diversification reduces our exposure to single risks such as power price or such as weather patterns. And because we generate revenues across a range of different frameworks and a range of different technologies, it means that we are less exposed to those singular risks. That diversification also gives us the opportunity to target higher returns than would otherwise just be achievable with that narrow focus on wind or solar.
You voluntarily report under Article 9 of SFDR. What does that mean in practice for investors?
So really what that means for investors is that they can place reliance on our sustainability credentials and also our commitment to those sustainability goals that we've set ourselves. So the voluntary election that we've made, combined with the disclosure and the transparency that we are keen to give investors, really makes a statement around where we see ourselves as a fund and what we want our investors to take away from that. And it also helps them to compare between the funds in a more appropriate and simple way.
Can you give examples of how you engage with portfolio companies to improve their ESG performances?
Yeah, so a good example of that is a fairly hot topic at the moment, which is biodiversity. So one of the things that we have done in recent periods is seek out independent habitat management plans for each of the assets that we manage. So that informs how we can improve biodiversity, what initiatives that we can actually put in on the ground that make a difference in that regard. So that might be something as simple as improving grazing patterns on agricultural land, or it might be installing some bird boxes. Whatever that might be, the scope of the work will be tailored to that individual site so that we can really make sure that this is something that's considered by not just the operators of those assets, but the boards that are responsible for each of them.
What are the biggest risks you see to the portfolio over the next few years, and where are the biggest opportunities for growth?
So the biggest opportunities for growth in our portfolio would certainly be within our growth assets. That is our investments into the clean transport platform, our co-located glasshouse, and our land-based aquaculture facility. These investments are all at an earlier stage in their life cycle, but we hope that as we work for the operational ramp-up, they offer the potential for meaningful capital growth and higher returns than would otherwise be achievable just compared to investing in wind or solar. At the same time, there is a lot of work for us to do on those assets. As I say, they're all at an earlier stage in their life cycle, and as we progress them through early operations and that operational ramp up where we are growing revenues and growing our customer bases, we will look to mitigate the risk associated with achieving that growth potential that we're targeting.